Except I'm going to disagree with David Zervos. I think Steve might as well. And this would be my take, David, which is that minutes aside, the fact that 9 voting members were thinking about hiking rates goes to an inflation story. And I think the inflation story, I thought, was an important one to the markets.
So let me just pick a bone there with that, because I think it's actually outrageous what happened on the committee, and it shows not an inflation problem, it shows a political problem, Brian. We had nobody on the committee in March that saw a rate hike by the end of the year. That's March. We go to June, and now 9 people see a hike by the end of the year, including one person that moved from no hikes to 3 hikes. We had 5 that went to 2 hikes. We saw an extraordinary move for Kevin's first meeting. And all of that time, the inflation expectations, which are really the backbone of what the Fed's mandate is, anchoring long-run inflation expectations as measured through the TIPS market collapsed between March and June. In the front end, they were down over 100 basis points. Most of those inflation expectation numbers now sit at their lows of the year. I think this is one of the most disingenuous dot plots I've ever seen. It's almost like a pick-me dot plot, like I'm important, I'm trying to save my importance because Kevin's trying to get rid of the dot plot completely. They're just sort of having their heads dunked below water, and they're trying to come up and try to sort of create relevance. I don't see relevance. I think it's not a story that is going to attach for very long, because the oil prices aren't going to give them the ability to attach that story for very long. They were already back to oil prices, even with today's move, up a little bit, hardly at all, by the way, really, given what's happened. It's hardly moved since that March period. So I think there's a lot of political turmoil, and the biggest risk at the Fed is not about inflation or anything related to the economy. It's about rebellion in politics. And I do think we have to worry about that. We have to worry about whether they can create a rebellion on the committee and get a 25. Even if they were able to do that at the July meeting or one of the meetings before the midterms, we would probably see the market yawn.
Brian, I want to make an important point here, which is you can take the man out of the Fed, but you can't take the Fed out of the man. My man and friend David Zervos says the Fed doesn't matter, but you can hear how he raises his voice and gets very animated. David cares an awful lot, and he's been watching this for many years. I would just disagree on one thing. I think some things did change, which is that when you look at what they're saying, David, and I'm not saying they're right about this, but it was the inflation that they saw beyond oil prices when they talk about it affecting other parts, that services ex housing had remained elevated or declined very little. And there's this gathering issue. And I will say, David, I was one of the few people, I think, that went into the meeting not surprised when the result was very hawkish, because if you paid attention to what they've been saying in the lead up to the meeting, they have become more hawkish, more concerned that they're not hitting their target, more concerned that there's another thing that they now have to look through that ultimately could undermine the inflation expectation story, which I would not disagree one bit with you about what's happening in market-based expectations, but some of the survey-based expectations, particularly yesterday, the New York Fed, have become concerning. So I think there is reason for them to be concerned. And I think other people who have this other attitude out there that, hey, this is going to dissipate, sure, roll the dice and play that game if you want. But let's remember one thing, David. They just went through a period where they saw inflation as transitory, and they got burned in a very bad way. And I think that colors their views right now.
Let me just say one thing, Steve. And you're a smart guy, and you could put a dot plot together as well as anybody. In that intermeeting period between March and June, one committee member went from 0 to 3. 0 to 3. Can you find any justification in what you just said with inflation, the outside of energy, in housing? Was something happen between March and June that could cause you to go from 0 rate hikes to 3 rate hikes by the end of the year? The only thing that really changed is that Kevin Warsh came in, Jay Powell went out, the committee's politics are moving in a direction, and there's people who are rebelling against that political move. That's what I see. It's sad, but it's reality.
David,
the Fed is a political animal. There's no economic story there that supports that.
We're going to bring Rick Santelli in just a second, but I want to ask you this. Do you think the Fed minutes are less important here, David, or do you think the Fed itself is less important?
So, Brian, my writing at Jefferies and my thought process with having Kevin there is that there is a sort of narrowing of the Fed. That's largely what I think is happening here, and a creation of less forward guidance and less market guidance, and by definition, almost less relevance. There's not going to be this constant hanging on every word. Did they say some? Did they say many? Did they say only? Did they say never? All of this is going to be washed aside, and it's just going to be less of an impact on markets, and markets are going to be left to do things without the Fed pushing them in a significant direction.
Hey, Brian.
That said,
Brian, I want a quick answer at that.
Yeah, but one thing I'll say is I also just think, Brian, my opening salvo was to say that I think the technology drivers of our market, the deregulation and pro-business policy drivers of our market are so powerful that it really doesn't matter that much that Fed rate expectations have changed almost 100 basis points in the last 4 months. That's the most important thing we've learned this year, that a 100 basis point shift in short-term interest rate expectations was not only didn't derail the economy and the financial markets kept going and got even stronger, and markets did incredibly well during that period. It just tells you that the underlying strength of this economy, the resilience of this economy, is incredibly strong.
Just very, very quickly, Brian, I think the minutes become more important if the chairman is going to say less at the meeting. Finally, Kevin said he wanted a family fight at the meeting. I think he got one. I think these minutes reflect that.
Well, I wonder if we're the family fight. Let's bring in now Rick Santelli as well from Chicago, who's been listening. Got David and Steve still there as well. Rick, you've been listening. What's your take?
I have. All I could say is if David was right here, right now, I'd shake his hand because it is so obvious he's correct. The market is looking right through this because the market understands that the Fed was never supposed to be the monster of the universe, okay? And that's what happened. And maybe that started during the credit crisis. Maybe that started with Ben Bernanke and it carried on through Janet Yellen and Chairman Powell. But that was never what the Fed was supposed to be. The Fed was supposed to be a nudging entity, and it was supposed to monitor and make sure nothing really fell off the tracks with regard to banking and rates. But what they've done is they've gone way over their skis in a number of areas. And I think the market right now doesn't consider the Fed unimportant. It just considers what the market's doing more important. And the market doesn't need the Fed to guide it because ultimately, as David has pointed out, and I've pointed out many times, the dot plots really weren't anything that you'd want to give your investment advisor is a roadmap for your money.
I agree. Listen, I'm not a dot plot fan either. I called it the Fed Light Bright.
One more thing on inflation. Transitory may have been their biggest faux pas, but until Mr. Warsh came in, they certainly didn't seem to be worried about inflation. And you add in the politics of Trump's war, and boom, all of a sudden this inflation's coming from everywhere.
So important.
Okay. How can you say, Rick, that the market is looking right through this when we have a 2-year at 4.18 right now?
It hasn't moved.
It hasn't moved because it knows.
Because the market's got a brain. The reason the market's at 4.2 in a 2-year is because it had priced it in ease,
here we go.
And now the investors are going the other way. Oh, no, not
They're not going the other way.
Words in my mouth.
They're not going the other way, Rick. They're at 14.
Steve. You think we're at 420 because of the Fed? We're at 420 because things have heated up.
If you're both talking at the same time, the viewer does not get the benefit of your great intellect, both of you. See what I do?
I'm not talking.
Sometimes I feel like
that's really good.
Ann B. Davis as Alice. Sometimes when the Bradys would have a fight, Ann would come in and she would be sort of the deciding ninth vote. That's see what I did there. So Steve Liesman, respond.
I'm just saying the market has already priced in a higher funds rate. It's at 420. It's up. The minutes maybe didn't have a whole lot of new information, simply reflecting the verbiage of what we knew was the case of a divided Fed. But I have a hard time seeing at these elevated Treasury yields how the market is looking through the overall idea that there's just some risk out there and a priced-in risk in the futures market. It's priced in the 2. It's priced in the 10. Rick Santelli taught me to watch and believe in what the markets are saying, and these markets are saying the Fed is going to be higher.
So, David,
okay, now it's my turn,
Go
right,
ahead.
Brian? My turn now? Okay. I agree with everything Steve said, but the market isn't doing that because of the Fed. The market's doing that because investors understand what's going on as well as what Steve thinks the Fed understands, okay? The market sees what's going on. It sees that energy prices were elevated. It sees the supply shock. It sees tariffs. It sees everything. And let's not forget, it sees the equity markets cooking in grease with historic records multiple times every week. That is an environment for higher rates. It isn't all due to the Fed, which is what Mr. Zervos is saying, that all roads don't lead to the Fed, even though many believe that they do, because it gives them a topic to talk about where they're never wrong.
David Zervos?
I just want to know who's who on the Brady Bunch here, Brian. Like, which characters are we playing? You know, we got Greg, we got Marsha. I don't know. I think everything was said. I think Rick framed it very well. I think Steve framed the other side very well. I don't think there's much to add. The Fed is priced. The market is priced to hike because there's a risk of rebellion.